I remember when I first started, I met with a man in the office who would eventually become my mentor. And he took me out to lunch because he wanted to get to know me. And the first thing he said to me was that the mortgage industry has a 75% failure rate. And he said, there's a good chance that you will fail.
Welcome to Real Estate U, the finance edition. And today I have a very special guest. He's from Allied Mortgage. And this gentleman I've known for, I don't know, has to be close to 20 years now. I'm sure that he'll fill me in on exactly when we met. But Dominick Lombardo, he's with Allied Mortgage, and he's one of the top lenders in South Jersey. And he's the lender that we utilize within our offices at Wiessner Realty. He's written hundreds of pre-qualification, pre-approval letters for us, and we're going to get into some of the inner workings of how this dynamic part of the business works. Dominick, welcome to the show.
Thanks for having me.
Yes, it's awesome to have Dom here. And how long have we known each other?
I would say if it maybe not quite 20, but at least 15.
Somewhere right in there, right?
Yep, for sure.
Yeah. So we've been together for a long time. Have you always been with Allied, or did you come over from another company?
I came over from another company. So my career is at about 19 years and 5-month mark. And in those 19 and a half years, I've been with 4 mortgage companies.
Okay.
And we actually met at my previous company. And then I've now been with Allied for about 11 and a half years. And we've been working together my whole tenure at Allied.
Was that Superior Mortgage?
No, I was with Franklin American.
Franklin American.
Yeah.
Oh my God.
Yeah.
Yes.
And then prior to that, I did a very short stint with a company called Carnegie Mortgage, and I started my career at Gateway Funding.
Awesome.
Yeah,
Awesome.
so-
So you've been around for 19 years in the business.
February 1st, 2005.
What would you say the average loan officer, what's their longevity typically?
Well, it's hard to say when you say average loan officer, but I remember when I first started, I met with a man in the office who would eventually become my mentor. And he took me out to lunch because he wanted to get to know me. Before he took on the responsibility of training me, he wanted to see what kind of person I was. And the first thing he said to me was that the mortgage industry has a 75% failure rate. And he said, there's a good chance that you will fail. And, being a young kid out of college, I was like, that wasn't the meeting I was expecting to have. But,
Right.
Luckily, through hard work, I was able to, create longevity in this business. But he was spot on. In the next 2 years, I would have worked with 4 other new loan officers. So there was a total of 5 of us. And I was the only one to make it, past like 2 or 3 years.
Wow.
So, that would suggest a, 80% failure rate.
Correct.
So yeah, he was right.
So you're good at math, I see.
It's one of the prerequisites. Yeah.
All right,
Yeah.
That's good. That's really, really good. So when, I guess, did you always want to be in finance, or is it something that, how did it unfold?
So I don't think anyone grows up saying, hey, I want to be a mortgage banker. For me, my roommate in college, his dad ran a mortgage branch for Gateway Funding. And he said to me, he's like, once you guys graduate college, I'll give you a job. And that was 2002, 2003, 2004. And I was like, well, yeah, that sounds like a good, that sounds good. And he said, my guys are making more money than brain surgeons. And I was like, this sounds even better, So I graduated December of 2004. I started working for him February 1st, 2005.
Wow.
Come to find out, back then at that time, it wasn't quite brain surgeon money, but as the years went on, it became more, cardiologist money without all the schooling. So it's definitely, it's a lot of fun. It's a very rewarding industry, and it can be very lucrative if you work hard at it.
So were you loaning money out on the playground to kids like in 8th grade? Were you doing that?
I wasn't doing that, but in a different life, I could see myself doing that.
So you came in during a boom time, really. That was a really good time in real estate, 04, 05, 06. And then things started to kind of shake in 07, and then bam, what happened in '08?
So there was a sharp decline in '08, and that was, even before that was when we started to see a lot of those new loan officers who had come into the business, chasing the money. We started to see them drop off. And at that time, there was a lot of subprime lending going on, and a lot of these new loan officers were gravitating towards the subprime market. And I sort of stayed away from that, and I was studying government and agency loans, FHA, VA, USDA, Fannie Mae, Freddie Mac conforming loans. And I learned, those loans. And I also went out and created contacts with real estate agents and built a referral system versus some of the other loan officers at the time. They were buying leads, doing subprime loans, things like that. So when the subprime market completely crashed, a lot of those loan officers, were looking for other jobs, whereas I was slowly building my business.
Building a base, a real base.
Yeah.
You were building it on the rock,
right,
on the sand. The subprime, what was the attraction to subprime? Was it more lucrative in the short run?
It was maybe you could look at it as being more lucrative. It was a lot easier. And it was easier to get things done, easier to get people loans who really weren't creditworthy to get those loans.
And that was because there was not the government oversight. It wasn't FHA or it wasn't Freddie or Fannie Mae backed. Is that why the money came from private investors? Is that what was happening?
Right. And at the time, the private investors were creating their own guidelines, which it was their prerogative to do so. They were lending their own money. The government agencies and Fannie Mae, Freddie Mac, their guidelines were set up to have lenders practice responsible lending, whereas the subprime loans were coming from private investors, a lot of them coming from Wall Street, and at the time they were just looking at a return on their money, and they were getting big returns on their money. They were also making risky loans, but they were doing it against collateral that was ever appreciating. So they thought, even if these people don't pay, we'll just take their house and we'll be safe because there's a lot of equity and the collateral's going up and up. When the market started to slow down a little bit, and this collateral wasn't going up anymore.
The market slows down. It could go the other way.
Believe it or not, there are times.
Is that true? Yeah, it is so true. And it's funny that it's not funny at all, because it was a really painful time for many. Especially us in the business. But I think that the newer generation, having not gone through that, they just are kind of thinking the same thing right now. So are we in the same boat now as we were back in, say, the precursor days of 2006 or 2007? Are we there now?
Right.
I don't know, right?
Well, I have a theory on it. Well, not a theory as much as an opinion.
Tell me about it.
I think that, from 2002 to 2006, we saw appreciation in real estate, going up a lot. Like, it was, extraordinary. And I think, and I'm not blaming it just on this, but at the time we didn't have a lot of restrictions on the way appraisals were done. So if I wanted to, or if a agent wanted to sell a house, and I wanted to do a mortgage on it, and the house true value was maybe like 150, but we were trying to get the buyer to buy it for 200, we could call the appraiser and say, hey, what can you do to get me this value? And a lot of that was happening. And the appraisers, I'm not saying that they were doing anything necessarily wrong, but they were playing a game that had no rules and no regulations. So they were able to have the flexibility to overvalue these homes. So then when the market slowed down and the true values started to come back, a lot of these lenders had loans on collateral that were now devalued compared to what they first were valued at the inflated price that the appraiser came back at. Now, in today's world, we have stricter rules and regulations on how appraisals are to be done. So not to say that the appraisers can't, they have all the flexibility to truly value a home for what it's worth, but they have the restrictions in place to prevent them from going too far over and inflating the value, which I think is going to help us when the market does slow down. It's going to help the slow be a little bit smaller versus such a drop off of a cliff. The
supercharger, the super igniter, was that a lot of these buyers that were being qualified, they really shouldn't have been qualified.
That's part of it too, for sure.
And that was the, I guess, the lax standards of the subprime, loan at that point. And, it all kind of went bad real fast. And it was really quite a rough 4 or 5 years after that. The aftermath, it wasn't just a couple months and we were done with this. There were trillions and trillions of dollars in bad loans that the market needed to absorb. And it took that long to absorb it. I remember foreclosure after foreclosure after foreclosure then. It seems so far in the rear view, but it kind of almost feels like we're approaching that territory again here. And it's the same thing right now. The sky's the limit, right? This market will never turn. What's going to turn it? I'm not sure about that. And if I'm thinking about this, logically, and I've been wrong many times in trying to predict, where the market goes. The market likely goes higher, in my opinion, here if the interest rates go lower. And we'll talk about this a little bit more in detail. But it's kind of precarious, I think, the entire situation now. And we'll get into the younger generation kind of being priced out of this market, which I do believe is happening
for sure
right now. And there's going to be some other things coming up that are going to be making it more problematic for buyers to buy. And we'll perhaps get into some of those things. But it's history is repeating itself, it seems. But nobody's talking about it. So maybe we should talk about it a little further.
Yeah, I think another reason why in '08 I think we saw such a sharp decline that we won't see now is a lot of those subprime loans were making loans with little to no down payment required. Right. And in today's market, we have a version of subprime loans. We have a version of subprime products out there. We now call them non-QM. They're very similar to subprime, where these loans are made by like private investors. But these private investors have changed a lot of the guidelines for them, and the biggest guideline change has been a down payment requirement. So if you have a lower credit score, yes, if one of the agencies won't lend you the money, there is an alternative product for you, but you have to have a larger down payment. Which I think helps a lot because your down payment is your skin in the game. And that's why lenders are always so careful when we source where the money comes from for down payment. Because people who have money invested into a property are more likely to pay that mortgage because they have something to lose. Whereas a person who put nothing down to buy a property, and if things get tough, it's easier for them to walk away from that property because there's not much for them to lose. Their credit will get banged up, but the credit bounces back. But they don't lose the $30,000 or $40,000 or $50,000 down payment because there was none. If that's the case. Whereas now the down payment requirements are a little bit stricter. That they're more likely to do what they have to try to stay in the house. Because if they walk away from it, not only are they losing their house and temporarily banging their credit up a little bit, but they're also going to lose that down payment money that they don't want to lose.
Do you remember back in the day? I haven't really seen it recently, but they would have the 80% first loan,
right,
and then they'd have the 20% second loan,
right.
So it was 0% financing.
Yes,
and if I recall correctly, there were actual loans that were just zeroed down, like straight up.
There were,
right?
Yes.
So that just created the madness, all around. And have we just gotten subprime? Is that synonymous with hard money? Is that kind of the same thing?
No, typically when you use the term hard money, you're typically talking about an individual, and it could be a company too, but a lot of times it could be an individual who is lending money to investors who are using the money short term. They want to purchase a home, fix it up, and then flip it. So they're looking for like these short term loans where they're paying higher interest rates, but they're okay with it because they don't need the money for very long, and it's easier to deal with hard money versus going to the bank. With non-QM, I think things would be a little bit different because non-QM products, which would be like today's subprime, they're making loans based off of the buyer owning the home for some kind of extended period of time. So even if it's an investment property or a vacation home or a primary residency, they'll have products for all three of those different types of homes. But the intention is for you to hold on to this loan. And at least I think lenders typically always want to try to get 6 months of payments. Whereas the hard money lenders, they know that they give you a 6-month balloon. So they actually want it back within 6 months. So with those types of loans, they're charging you higher fees up front and higher interest rates along the way, knowing that they're only making the loan for somewhere between like 2 or 6 months. So it's a little different.
And the interest rates on the hard money would be 11%, 12%, 13%, things like that.
In that range, yeah. And a lot of times could cost, on a low end 1%, but on a high end 3% up front.
So that option is probably best suited to investors. They want to buy the property and flip the property. So that would be a good method to do it with the hard money that way.
Right.
And it sounds like the subprime of today, which I still don't know the acronym that you were using, that would be more of a traditional 15-year loan, 20-year, 30-year loan.
Right.
Sounds like.
Right. And then they have fixed rate options. Also, they have some adjustable rate mortgage options. But yeah, that would be different.
We don't have to get into a long debate about adjustable rate mortgages, but they were all the craze back then too. And I'm sure that they're still around, although I haven't really seen many crop up these days.
They're definitely around. I have yet to see where an ARM makes a whole ton more sense than a fixed rate right now. So
right. So you wouldn't recommend that. You probably don't. That's kind of only if you have to use one of those apparatus. So how do you become a loan officer? How do you do it? Like, do you go to school and take classes, or is it something that's outside of the typical college university setting?
So it's definitely something that's outside of the typical college university setting. There is no.
So you don't have to go to college to do this.
You definitely do not have to go to college.
Do you think you should or not?
I think that I don't think going to college is a bad thing. I think if you have an opportunity to go to college, I think it helps make you a well-rounded person. But I wouldn't go to college just to do this.
Right.
But they always say having a college degree is one thing they can never take away from you. So not to say that people shouldn't go to college, but I'm also in the school where just because a person didn't go to college doesn't mean that person can't be very successful and be a contributor to society. But how you become a loan officer, there are a couple of big banks out there, big mortgage companies that hire lots of young people and put them through rigorous training courses. And then after 6 to 9 months of the training, then they put you on the phones and you call people, you try to get them to refinance or whatever the case may be. The success rate in that type of setting is like very, very small. A lot of times those people go into other things in the mortgage industry. They don't necessarily become loan officers. They may become processors, underwriters, something different. But that business model is not real popular. You almost have to know somebody because a lot of these mortgage companies don't really want to hire new people to train them because mortgage companies aren't set up to have that kind of capacity. They want to hire seasoned loan officers that can come in right away and start making the company money and being successful. But if you know somebody who is willing to train you, then you could get a job and kind of work under somebody for a period of time.
In order to get the ability to make calls, do you have to be licensed?
You have to be licensed to negotiate lending terms. So I would imagine to make calls, if you can call somebody and get them to agree to talk to a licensed person, I guess you don't have to be licensed. But once you start negotiating lending terms and financing terms, that's where you have to be licensed.
How there's 75 hours and you pass a test with the state and you're a real estate agent. Is that the same kind of schooling?
It's you have to take a course of 20 hours, which we still do continuing education for 20 hours. My 20 hours covers it's either 12 or 20. It might be 12, I'm sorry. That covers my federal and my New Jersey and my Pennsylvania license. So you have to do that, and you do have to pass an initial test to get your license. When I first started, it wasn't that way. When I first started, my first boss sent my name, my social security number, and $25 to the state, and I was a licensed loan officer. Over the years, things have changed, and now even being licensed, none of us were grandfathered. We still had to go through and do our, I think it was 20 hours initially or something like that, and then take our test. And I had to take a test for federal, for New Jersey, and for Pennsylvania. And then once I passed those tests, I never had to take those tests again. And then as long as I keep up with my continuing education.
So the bar is ridiculously low to get in.
We sometimes we make comments like that. Yeah, they'll give a license to almost anybody, but it's
and you could. I mean, I know you do very well. I know loan officers do very well if you're working the business the right way and you're able to generate contacts, leads, good relationships with the agents. So yeah, it
can be very lucrative. And to kind of segue on that, individually, our licensing requirements aren't as strenuous as maybe other positions in other industries. But mortgage companies individually have to maintain a lot of different licenses. So there is, when mortgage companies go up for sale, there's a value in the licenses that the company holds. So the last time I checked, I think Allied maybe had 35 to 40 states licensed, something like that. I do all my business locally, so I only needed a Jersey and Pennsylvania license. But the bigger, more successful companies will hold more licenses.
There's a definition variation. Mortgage broker and mortgage banker. What is Allied?
So we are a mortgage banker. We are a direct lender.
And banker I always thought was better.
I've never been a broker, so I would agree with you. The difference is...
But I'm not sure why I think that.
So the difference is, as a banker, like I said, we have our own money to lend. So I make a mortgage to you, I lend you the money. Now, after closing, we will definitely sell that mortgage to Fannie Mae or to Freddie Mac. We also might sell the servicing of that loan, which we may sell to, let's just say, Wells Fargo, because everyone's heard of Wells Fargo. Sometimes the borrowers think, oh, you sold my loan to Wells Fargo. I said, well, we sold the servicing rights to Wells Fargo. When Wells Fargo bought the servicing of your loan, what they agreed to is that they would service your loan, meaning that they will collect payments from you. They get to keep a small fee for themselves, and they give the rest of the money to Fannie Mae or to Freddie Mac. Now, Allied has the capability, and we do this, where we keep some of the servicing of our loans. So a certain percentage of our borrowers, after closing, will make payments to Allied Mortgage. Even those borrowers got sold. They don't realize it, but we sold their loan, or sometimes in the business we would refer to as the paper. We sold the paper to Fannie Mae or Freddie Mac. They own the actual loan. But at Allied, we decided to keep the servicing of it. So you receive a monthly statement from Allied Mortgage. You make your payments to Allied Mortgage. If you have a question or a problem, you call Allied Mortgage, and we take your payment. We keep a small fee for ourselves, and we give the rest to Fannie Mae and Freddie Mac.
It's a transference of risk at that point. Is that why it would be more beneficial to have the huge entities of Freddie and Fannie hold the paper at that point?
Right. So that Fannie and Freddie are quasi-government entities. They are funded by the government. They're regulated by the government. They're backed by the government. And because of their existence, lenders are able to make loans to more borrowers and help more Americans have home ownership. And there's some talks of this, and I hope it doesn't happen, at least I hope I never see it, but if there was ever a shift from Fannie and Freddie and the government's involvement in home loans to a true private sector, then we would see stricter guidelines, and the end result would be less Americans would own homes, because all of the 3.5% down payments or 3% down payments, 5% down payment options would probably become, more and more rare, and requirements, the down payment requirements would be a lot higher, which first-time home buyers, the biggest obstacle for them is the down payment. Most first-time home buyers make enough money. Most of them have good enough credit. It's just hard for them to save the big down payments.
I was, in my reading and watching a lot of YouTube videos, which I enjoy doing, the money, and correct me if I'm wrong here, the money that is used for loans is actually created by the loan itself. That's the new money introduction. It's money that was never in the system, that when that loan is made, that's brand new money that gets injected into the system. That's the fuel. Is that correct?
Maybe part of it. So there's something called mortgage-backed securities that people like us could invest in. And the money that investors put into the mortgage-backed securities, a lot of that money is used to lend to people. And the interest that the homeowners pay on their mortgage goes back as the return to the investors who invested into the mortgage-backed securities. So I imagine that the interest that's being paid would, probably help funnel some of the new money as well.
Right.
But that's how that works. And sometimes you'll hear loan officers or anybody talk about the 10-year Treasury bond. Why is the 10-year Treasury bill so important to mortgages? Some people think that's the money comes from the 10-year Treasury. It doesn't. But the 10-year Treasury bond and mortgage-backed securities are in competition with each other. So mortgage-backed securities are typically higher than 10-year Treasury bonds, because that's how mortgage-backed securities will entice investors to invest in mortgage-backed securities versus the 10-year Treasury bond. That's where we get the money to lend to the homeowners.
Oh, okay. So it's a little more complicated. They also say that money that gets deposited at the bank, you bring, you're saving your money, you deposit $1,000. Well, then the bank can turn around and lend 9 to 1 on that. $9,000. Is that true?
So that would be more for banks who are lending out of their portfolio. That would be some like non-QM stuff or some bank portfolio lending. So the type of lender that I am, we make a loan to you, we sell it to Fannie Mae, Freddie Mac, whatever.
So you're getting the money from the quasi government, Freddie Mac and Fannie Mae, versus the local bank or the regional bank.
Right. So, logistically, since we're on the topic, the way that it actually works is we initially get the money from a warehouse bank, which, think of it's a warehouse of money. So the day of closing, you need $300,000. We fund your $300,000 from our warehouse bank. It's like a line of credit that we have. We fund that money. Then within 30 days later, we sell the paper to Fannie Mae, who gives us the money back, and then we replenish the warehouse line. With the bank lending out the depositors' money, that would be the bank's own portfolio where they are the lender. So after closing, they're keeping the paper. And talking earlier about how if there were ever a shift to the private sector, we would rely on banks to do that. And when banks are lending their depositors money, they're going to be a lot more careful with it. So the guidelines are going to be a lot stricter. Whereas with the agency loans, the federal government is taking on some of the risk, but they're doing it because that's the role the government plays in home ownership. Because over the last 50 years or so, we've noticed that the United States economy relies heavily on how real estate is doing in the real estate market. So and it's also, I think, one of the ways that we maintain a strong middle class. And I think that's important in a democracy and in our country, not to get too political, but it's important to us to have a good middle class.
In history, it's really quite rare to have a middle class. In the United States, we've created that segue, and it has benefited society at a large. There's no doubt about that.
Yeah.
So a lot of that does come from real estate and the equity and the wealth that's been built that way. I looked at the debt clock this morning. Have you ever looked at that?
No, I haven't.
Don't. But anybody that is interested in really seeing what's going on, if you want your mind blown, go to debtclock.com. You just put Debt Clock US, and it has all of these calculuses of what's going on up to the second. And it's a pretty frightening dynamic if you really look at the numbers. $34.8 trillion in debt is what the United States is, but long-term total obligations are over 120 trillion, 125 trillion dollars. So it's like, it always amuses me when, it's backed by federal funds or it's backed by the federal government. We're in the hole almost $35 trillion, and then some.
It's hard to understand that figure.
Right.
Like, yeah.
I mean, are we in trouble?
I mean, it's hard to say. I like to think that, we have everything under control, but
is our GDP enough to, keep that rolling for how long? It's an equation that doesn't work out forever, but maybe in our lifetimes we'll never see it.
Yeah, it's hard to say. I think, over even thinking back 100 years, our country, we produce so many less things than we used to produce. And manufacturing used to be a larger sector of the economy. Going back to what I was saying earlier about real estate being such a large sector of our economy now, is because we've lost other sectors. We really don't make a whole lot anymore.
There's a stat on the Debt Clock that has manufacturing jobs, versus what it was 5 years ago, 10 years ago, and it's quite chilling when you really look at it.
Right.
So the interest rates right now, it's all the talk, and people are very concerned and interested, especially if you're entering into the real estate market, about interest rates. How do you feel about where the rates are right now, and what are the rates?
So rates are somewhere in like high sixes, low sevens. Depends on credit score, equity, things like that. So it's hard to say. Sometimes people ask, what's the rate? There is no rate, but it's in that range right now.
Right.
It's no secret that right now business isn't as booming as it was, and we're in a what we would probably refer to as like a slower market. The reason why I'm not busier individually is not because of interest rates. I have plenty of people that want to buy houses. I talk to new buyers every single week.
Right.
The problem right now is inventory. And you and I have been doing this for a long time, and we've been in markets like this before. I feel better in this type of slow market than I do the alternative slow market, which is no buyers and too many houses. Those markets where you drive down your street and you see 5 or 6 for sale signs that have been there for 6, 7, 9 months. And then your phones aren't ringing with any new buyers, and those markets scare me more. These markets, I think, will kind of come out of the hole quicker because finding the willing and able buyers, I think, is the hard part. Getting people to sell their houses will kind of come.
Right.
I think that the rates are probably contributing to people not selling their homes, because a lot of people probably have low interest rates that they don't want to give up. And I can understand that. But naturally, people need to sell homes, whether it's estate situations, or people raised a family in a 2,500 square foot home, and now the last one just went away to college and there's no need for that big house anymore.
Right.
And then you have the flip side where people want to upgrade to not only a bigger home, but maybe a different township, a different school district. So there's always going to be reasons for sales.
The legacy interest rates, as the market was trying to crawl out of the disaster that was 08, 09, into 2012, those rates were, in some cases, all the way up to, say, 2020. Some of those were 2.5%, 3%, 3.5%. And the sellers don't want to give up that rate for a 6 3/4 or a 7%. And they're just saying, you know what, I'm staying put. And what's interesting as well, there's another dynamic where the new construction is not nearly the pace as it has been in the past. And those two factors are causing that inventory shortfall. If the interest rates were to fall, and I'm going to ask you this in a couple minutes, like why are the interest rates where they are anyway? But if they were to fall, you give me your take on it by, say, if they were to get down to 6.25, what do you think would happen to the market? If they got into the high fives, what would happen to the market?
I think you would probably see more homes coming on the market because that kind of softens the blow a little bit. So let's say if you have a group of sellers or a group of homeowners who are thinking about selling for any of the reasons that I just mentioned, but they're hesitant because of the interest rates, let's say. We don't want to give up our 3.5% to go into a 7%. But maybe a portion of that group would be willing to give up 3.5 for 5.5. You know, a 2-point spread's better than a 3.5-point spread.
Right.
So I think that may help a little bit. So yeah, I think that could help.
Yeah, the interest rates are. I really believe that for every one buyer that is out in the market right now, it's holding two buyers back. I think that's how strong the current is right now. And if there were to be a little bit of a flex in there, I believe that the market could go significantly higher, even though it's been on this rocket ship up. I was looking at the stats today. Over the last, say, 4 years, most properties are up 60%, 65%, some of them 100%, depending on where you are. And my recollection of wages are that wages are up maybe 5% to 7%. So there's this huge disparity between wages and real estate. And if those interest rates go down, it could really create a updraft in activity where more buyers come out at that point and it jacks prices up even higher. I think that's the more likely scenario right now than would be that the market starts to fade and lose energy. There's just not enough new construction to make the existing inventory less valuable. It's just that strong right now.
Yeah. Well, I think rates are high because of inflation. So if things keep going up, that's going to contribute to inflation. And
where'd the inflation come from? Like why we didn't have any inflation, right? 2020 and then 2021, it was a slight uptick, and then 2022, everything just went crazy. A gallon of milk at Wawa, 2.5 years ago was $4, right? Now it's 5.25.
Right.
Like how much is that? That's like 30%.
Yeah.
Right.
Yeah. It's a lot. I'm not an economist, so I can't answer that. And if I gave you an answer, I would be making it up. But where exactly it came from, I don't know. But I know that higher rates is what is used to combat against that.
I have a theory. Do you want to hear my theory?
I would love to.
So COVID, there's depending on the stat you look at, $6 to $8 trillion that gets injected, out of thin air into the economy. And there was too much money chasing too few goods. Remember the supply chain and all that? Right. So there's just so much money that was generated that the market couldn't absorb it. So the interest rates, did end up going up. And I'm not sure if that money was spent or if it was saved.
Right.
So I don't know. I kind of believe that the money was mostly spent, but there'll be other commentary otherwise that it's been saved. But another driver is, I think, the prowess of the older generations on how frugal they are and were in some cases. And that generational wealth is bubbling to the surface in addition to the $6 to $8 trillion that was printed. And you have cash, I'm not going to say all over the place, but I've never done more cash deals than we're doing right now.
Yeah, no, that's a good point for sure.
So it's just thank you, Grandma, right, Grandpop. I mean, just and those generations passed it to the next, and they were still continuing the lesser living below the means, which I think is always a good thing to do. But that money has to go somewhere, and that's going in good part into housing, real estate, and the stock market.
Yeah.
And I tell you, they say the economy is not good, not good, not good. The thing about the economy that's not good is inflation, right? The rest of the economy is kind of rolling, right?
Yeah.
The stock market is at all-time high.
Yeah, it is.
Real estate market is at all-time highs. That's not normal in what was to be a recession,
Right.
which I never saw. Did you see a recession anywhere?
What, like recently or
Just like over the last, it was the
well,
whole
back in
drumbeat
Yeah.
over the last couple of years. Recession.
Yeah.
I haven't seen it.
No, I think part of the issue like now is going back to the middle class. I think we're widening the gap between the lower class and the upper class.
Mm-hmm.
And I think that's an issue because so we're saying how we're talking about inflation and values going up so much. There was a time 5 years ago that a single person who made a good living could purchase a home.
Mm-hmm.
A single person who made maybe almost $100,000, but not quite, could buy a home. It might be a condo, it might be a small single family, but they could buy a condo individually on their salary that was a little under six figures.
Right.
Now that person is completely priced out of the market.
Out.
And it's a struggle for two individuals who make okay money to even buy a house. It's just you need to have two almost high earning individuals today to be able to afford a home. And I think that's part of an issue.
No, there's no doubt about it. The skill sets that need to be developed, if you're not making it, you got to figure out a way to make it, I suppose. And, whether it be business or just applying yourself to another job, that's not what anybody wants to hear, right? But that's what the reality is right now in many cases.
It is, and I feel like in our country, in any country, not everybody can be an accountant, right? We still need everybody to make society whole. We need the contractors and carpenters and plumbers and even custodians and the trash collectors. Like those are all honest livings, and those folks should be able to go to work every day at those types of jobs and still be able to afford a home in some neighborhoods. They're not going to live in the same neighborhoods as the accountants, but they should be able to afford a home in some neighborhood.
I don't know if I had to do it again, Dom, I'd probably become a plumber.
I mean, so and I kind of touched on it earlier about how just because somebody doesn't go to college doesn't mean they can't be successful. I think that it would be interesting to see, and I think it's coming it's already kind of started, but a shift into the trades. And I think that the tradesmen that I know are very successful people. They still, the union ones have pensions. Pensions not something that you and I will have. They make good, honest livings. They make good wages. There's good benefits.
You got to make that choice, right? Early on, really, in your life, which direction do you want to go? Do you want some safety net, maybe a little less pay, or do you want no safety net, possibly more pay, but possible disaster?
Yeah.
So it's what makes, America great, I suppose.
I mean, in 2008, when we saw a lot of corporate layoffs, and even before that, actually going back more like 2002, 2003, 2004, we saw a lot of corporate layoffs. They were laying people off towards the top. And a lot of those people never rebounded. And I personally know a lot of those individuals. So I think if you have a trade, if you know a trade, then you are always going to be able to be employed.
I'll interject this. I think that the teachers of the world need to be paid more, and the police officers need to be paid more. So I don't know how we could maybe make that happen, but I think that there are two underserved professions that are of utmost mission critical importance.
Yeah, I agree. And I think that I would like to see more young people look towards those types of jobs, and to add into their, firefighters, EMT, first responders.
Absolutely.
I think, and even nurses, especially in our area, we're starting to see a lot of medical facilities being built.
I don't know how any of those people do it, really. There's such, human, you have to be such a people person, to be able to be good at those and to be effective. And, society depends, a thriving society depends on those people.
Yeah.
So, getting into just what Allied Mortgage does, right? What you do you typically write, and give me a little bit of variation between conventional loans and FHA loans and USDA, what's the difference between all these things?
So, conventional loans, like we talked earlier, would be backed by Fannie Mae and Freddie Mac.
Okay, that's key.
They, those are the quasi-government entities that back those loans.
Mm-hmm.
FHA is a loan that's insured by the federal government.
Mm-hmm.
So the government people sometimes think, the government lends the money on FHA loans. That's not true at all. That was never the case.
Mm-hmm.
The government, when it comes to FHA loans, acts as an insurance company, and they're insuring the lender 100%.
That's a huge point. I don't think many people know that, Don.
Many people don't know that.
Mm-hmm.
They think that FHA lends the money.
Right.
They think we send the loan file to the government for underwriting.
Right.
We don't do that.
Right.
We underwrite those files. We process those files in our office,
Mm-hmm.
and the government acts as an insurance company for
Mm-hmm.
FHA. With conventional loans, another fallacy, people think you have to have 20% down
Right.
to take out a conventional loan. That's also not true. We can actually do a conventional loan with as little as 3% down.
Mm-hmm.
Whenever there's less than 20% down on a conventional loan, we're required to carry PMI, or private mortgage insurance. People have heard that term before.
Sure.
So when we are in a situation like that, we reach out to a private mortgage insurance company and we apply for an insurance certificate on that loan.
Mm-hmm.
And they say, yep, we'll insure you to a certain percent. So if the borrower has 10% down, we require 25% insurance. So the private mortgage insurance company will insure us 25% of the loan. The PMI, the private mortgage insurance premium that's paid on that loan will go to the private mortgage insurance company, and they are a for-profit company.
Right.
Whereas on FHA loans, the same thing is happening, except for instead of getting 35%, we're getting 100% insurance on the FHA loan. And the mortgage insurance premiums that are paid are going to the federal government, where the federal government collects that money and use that money to pay any claims out that they have to pay to lenders.
And then FHA, they don't call it PMI, they can call it MIP.
MIP,
is that
right?
correct?
Mortgage insurance premium, yep.
Right. And the difference, and it's a graduated scale with the conventional PMI, where if you some of these are 3% down, right? I see that all the time, 5% down, 10%, 15% down. As you go higher up the scale, the PMI is less.
Correct.
Right.
The PMI is calculated based off of the down payment and the credit scores. So somebody that has a high credit score and is putting 15% down, they're going to have the lowest factor for the PMI.
Right.
Whereas somebody with a 3% down and a 680 credit score, they're going to have a higher PMI.
And you could not have PMI if you get to 22% equity in the property. Is it 22? Is that the number?
So at 22%, the PMI automatically is eliminated without any requests having to be made.
Okay.
At 20%, you can request to the mortgage company to eliminate the PMI, which you would just call and.
Right. So in this market, I mean, theoretically, you could have bought a house in 2022. It went up 30%. Bye-bye PMI, right?
I mean, theoretically, there's a little bit more to it. Sometimes there's a requirement on how many mortgage payments that you have to make.
Oh, okay. There's I see.
All the payments have to be made on time, and then you would have to have an appraisal done showing that the value went up.
One of the FHA is typically a little bit more lenient than conventional, where a lower credit score could qualify. My understanding is like 600 is still a qualifiable score for FHA, where you wouldn't qualify for conventional. Is that somewhat accurate?
Yes, definitely accurate. Also, too, with conventional loans, the interest rate is determined based off of the down payment and the credit score. So somebody with a 680 credit score who wants to put 5% down, even though they may qualify for a conventional mortgage, it would be a lot more affordable for them to go with FHA. So in today's market, listing agents and sellers sort of eliminate all the FHA offers right away because they have multiple offers to sift through, and that's the easiest way to eliminate, a few off the bat. But that practice is a little unfair because that borrower with the FHA offer isn't necessarily less qualified than the borrower with a conventional offer. It's just a matter of choice between two programs because the FHA one would be more affordable. So, that's something that we're experiencing now too.
The real negative to me for FHA is the MIP. It survives the life of the loan, right? So you never get rid of it, whereas you can get rid of it with a conventional loan. However, we could refinance that PMI or, MIP off of that FHA loan, as you get a little further down the road.
Right. And I think anybody buying a home in today's market, I think is going to have a opportunity to refinance for one reason or another in the near future, because we're expecting rates to come down at some point. And I don't know if it's 2 years, 3 years, 4 years, 5 years, but I think in 2020, 2021, when I had buyers purchasing homes at, purchasing homes with rates at 3.25, they were basically like, "Yep, we're never doing this again." And chances are they may not. But in today's market, I don't think anyone's expecting to have the new mortgage that they're taking out now be the mortgage that they have when they pay the house off.
And as far as any credit score, right, the standard that everybody talks about is 700 plus, right? But the scale goes up to 850. They say it goes to 900. I've never seen.
Yeah.
I've seen maybe an 860. Is that possible?
It's possible. I want to say I think the highest I've seen was like an 850 something. But
so how do you get to 850? And is there an advantage to getting to 850, or is 700 good enough?
Well, so the way that the scale works now, the best pricing is at 780. It used to be 740, and now they've changed the scales a little bit. But the difference in price between a 780 credit score and a 740 credit score is really not much. How do you get a high credit score? First of all, the 830s and the 840s and the 850s that I have seen over the years have been for my older borrowers. And I think the reason behind that is because they've established credit longer than younger borrowers have. They've always maintained their credit. They kept their debt low, and they eventually reached that 830 or 840 threshold. The best way to maintain, there's a few things to do to maintain a good credit score. First of all, pay your bills on time. I mean, it's simple advice, but really pay everything on time. Try to keep your revolving credit, which would be your credit cards. Try to keep the balances on those revolving accounts no higher than 30% of the limit. So if you have a credit card that has $1,000 limit, you never want the balance to ever go above $333.
That's going to be a hit for many people.
Because that's
on the debt clock. They have that stat too, what the consumer debt credit card is, and it's 1.4 trillion.
Okay.
And it's the highest it's ever been.
Yeah.
Like right now, me and you sitting here talking.
I believe it.
Maybe want to live below your means a little bit.
Yeah, it's it's important to try to keep that your revolving debt, and then also too, it's good to have established accounts. That also contributes to the credit report, to your credit score.
Right.
So those would be the ways. Now, also too, there are times when you need a new car and you have to take out a car loan. You have to do what you have to do. And when you take that car loan out, your credit score initially is going to go down a little bit. But with on-time payments, it'll eventually come back up. And somebody who's starting out with a high credit rating, when he or she takes that car loan out, yes, their credit score will experience a dip, but it's one thing to dip from 780 versus dipping from 680. So sometimes people think like, oh, my credit's going to take, it's going to tank because I need a car. So no, it won't. As long as you maintain a good credit score, you're going to go down a little bit, but when you're going down from the top, it's not as bad, and you will eventually quickly actually get back up there with on-time payments.
So on a say a $300,000 loan, which might be low these days, the difference between a 750 credit score and a 650 credit score, would that be nominal as far as payment? Are we talking like $50 to $100 more between that gap, or is it going to be?
No, it's going to be between 750 and 650.
Yeah.
No, it's going to be a huge gap.
It's a big gap.
Because I mean, that could be a difference from like 0.5% to 0.75% in rate.
Right.
So on a $300,000 loan, that could be like a couple $100 or more.
So it's significant. So get your credit scores good right from the beginning.
Especially when we're working with rates in the 6 and 7%. When we were working with rates in the 3s, it's not as big, not as big of a deal. But with these higher rates, it definitely makes more of an impact.
When you run, we get pre-approval letters from you all the time, right? But some lenders issue a pre-qualification letter. There's a different standard between the two. Can you talk about that?
Yeah, so generally a pre-qualification would be you spoke to a loan officer like me. They reviewed your documents and they deemed you as being pre-qualified. They haven't taken it any further than that. I issue pre-approvals because based off of my expertise, I know what underwriting is looking for. I also have the ability to run the loan profile through a automated underwriting system, which is the first thing that we do. So once I receive an approval through the automated underwriting system and I've reviewed the borrower's documents and have verified that the information that was put into the automated underwriting system is true and accurate, then I have the ability to issue a pre-approval, which says that they took it a step further and provided documents and it was ran through an automated underwriting system. And if for some reason I'm unsure, then I'll take a step further and ask an underwriter to look at it to confirm that, yep, these folks are good.
So the scrutiny is it's a much greater magnitude than a pre-qualification. Basically, you're just running a social security number as a pre-qualification and you're just asking, but you're not verifying.
Right. So a lot of times, in today's world, borrowers will go online and submit a quick pre-qualification check through an online lender, and they'll put the information in, and the online lender will, review the information and just spit out an automated pre-qualification letter. The borrower may never have talked to a human. The human may never have even looked at it. It's all just done automated. So you're relying on the borrower putting in accurate information, which, not to say that they would purposely, be deceitful, but sometimes they may not understand the question, or they think their income is one thing, but it's really not. The example that I give, and this has happened, where you have an hourly person, right? And you ask them, how much money do you make? And they tell you, well, I make like $52,000 a year. Okay, great. Why do you say you make $52,000 a year? Well, because last week I made $1,000, and there's 52 weeks in a year, so that's $52,000. And I said, well, logic makes sense. How much did you make the weeks before that? Well, the week before that I made $800. The week before that I made $700. So in that type of income, we have to average out the last 2 years basically. So for 1 week in the last 24 months, he made $1,000. That doesn't make his income as $52,000 a year. So again, and that person is not, I don't think, would be purposely being deceitful. They're doing what they think is logical math, but it's not the way the lender calculates that. So if that person puts that information in the automated, or puts that information on an online pre-qualification calculator, that pre-qualification letter is going to be null and void.
So my anecdotal, dealing with offers all day long that come in, and I see a pre-qualification versus a pre-approval. The pre-approval gets first dibs. I just believe that to be more stringent and more sturdy, more trustworthy. And as far as some of the bigger national online companies, my anecdotal preference would be the local vendors that really do the pre-approval. There is an advantage. So if you're looking to win the bid, you might want to stay local, and you might want to submit a pre-approval versus just a very simplified pre-qualification letter.
I mean, I think that it's really important too. And let's use our history together for the last 15 years. If you or one of your agents in your office makes an offer that's accompanied by one of my pre-approval letters, there's a good chance that the listing agent knows me, or if they don't know me, they know of me.
Makes a difference.
And they, a lot of times, may have had firsthand experience with me. So the listing agent is looking at it and saying, you know what, Mr. and Mrs. Seller, I know this guy, Dom. I know this company. I've worked with them. They're good. I'm confident that they'll get it done. This local bank out of Kentucky, I never heard of them. I don't know this person. I don't know how to contact this person. Right. I don't know if they'll get it done or not.
I know I can get you anytime.
Anytime.
Yeah, the relationship, it's often passé, but the reality is the relationship matters, and who writes the letter matters. And we do, as agents, we take very, very close look at those things. Yeah. So if you want to win, maybe consider, doing those local, doing it local with the local lenders. So there's one last thing. I don't want to take a whole lot of time on this, but I think it's kind of important. Maybe we can just touch on it. The old debt to income ratio. And you're going to have to brush me up on this because it's been a while since I've thought about it. But the debt to income ratio for conventional is more favorable than FHA. Would that be an accurate statement?
Well, it depends on your definition of more favorable. The debt to income ratio on conventional, the guidelines for the debt to income ratio on FHA are a lot more stringent. I'm sorry, on conventional are a lot more stringent than FHA. In other words, conventional guidelines require the debt to income ratios to be a lot lower than what FHA would require or would allow. So conventional, basically, debt to income ratios, they want them to be no higher than 45. It's not a hard stop at 45, but it's pretty much like the standard. We can get loans approved a little bit above that with compensating factors. So high credit scores, big down payments, lots of reserves. We might be able to push that to a 46, 47, 48 in some cases. There is a hard stop on conventional loans at 50. Right. You won't get anything approved over a 50 for the Fannie Mae Freddie Mac programs, as far as debt to income ratio goes. Okay. And FHA, there's a hard stop at 56%. But we could go up to 50 and even a little bit higher without those compensating factors. Right. So the debt to income ratio requirements and the allowable ranges are a lot more liberal on FHA loans than on conventional loans.
So that's it's kind of interesting that I guess it's the apparatus of the 100% government backed that allows that wider latitude.
Yeah. So FHA's role in our real estate market and financing sector is to try to help promote home ownership for people that are a lot of times in a lower socioeconomic group. Not to give you a history lesson, but FHA started after World War II, and it was something that was trying to help veterans coming back from the war and give them opportunities to purchase homes, because a lot of them didn't have big down payments because they were at war and their wives were working here to just support the family. But it allowed them to try to buy homes without big down payments and to be a little bit more liberal with the credit guidelines. And in today's world, over the years, it's gotten probably even more liberal to try to help, because one of the best ways for somebody that is in a lower socioeconomic group to improve their situation financially and to move up into the middle class is through purchasing real estate. Right. And that is also what will help to contribute to generational, I don't want to say generational wealth at that point, but to help generations kind of improve each each generation afterwards. So that's, that was the primary purpose behind FHA, and still used today.
Yeah, it's a good. It's a good way to bridge it, with the FHA. So don't shy away, agents from the FHA offers, right?
But there's also, I think, an old stigma with FHA with repairs. Years ago, FHA would come in the house and they would require all these repairs, and it was a standard. The appraisers were expected to find something wrong with the house. When I first got into the business, there was something called a VC sheet, which, to be honest with you, I can't even remember what VC stood for, but it was a form that was part of the FHA appraisal, where the FHA appraiser was to list required repairs to be made.
Right.
And if there was, and like they didn't have to do it, but there was a form for it. So there was like this pressure on appraisers to like list certain things to be done. So over the years, they eliminated that form. They kind of revamped the appraisal requirements and kind of told these appraisers, look, we're looking more for like true health and safety issues. You don't have to go around calling for every little thing.
That's big news, Dom. I really didn't know that. I didn't know that. I mean, we've been dealing with so much cash and conventional that it hasn't really been front of mind for me. But I'm glad that you mentioned that. So
there was a time when where termite certs were required on all FHA mortgages. No questions asked. That hasn't been the case in 15, 16, 17 years. I mean, agents will send me a termite cert and I don't forward it because we don't require it. Not to say that it's recommended for a buyer to get one, but from a lending standpoint, it's not a requirement.
Wow, things have changed.
Yeah.
So the debt to income ratio is important. 45. In today's economy, you're kind of putting yourself out there. 50, you're really putting yourself out there. 56, wow.
Yeah.
So I remember years ago that I guess what we would tell people all the time would be like 33% would be the debt to income ratio, but we were able to stretch it from there. But it seems like it's widened a little bit. So it's giving more opportunity. I guess there's more risk to some of the lenders that way, but that's the game we play, right?
Yeah. I mean, the government says that they will insure it, so we follow their guidelines. But not to say that
the government, of course, that's $36 trillion.
Right. Yeah. Why listen to them? But underwriters still have. I mean, they still have decision-making abilities on a loan profile. So if an automated underwriting system output says, yeah, you're good, underwriter can still look at it and say, well, Mr. Borrower, Mrs. Borrower, tell me why we should make this loan.
Right.
Because a lot of times there are some things that aren't considered. For example, in order to use somebody's overtime, we have to have a 2-year history of it. And we have to be able to establish a likelihood of it to continue. Someone might have a year and a half worth of overtime, and we can't use any of that income, but it's real income. It's really there. So that 56% debt to income ratio on that loan profile is what we're using to calculate it.
Right.
But in real life, it could be like a 51%. One of the spouses may not be on the mortgage because he or she has bad credit, but they still work. That's real dollars coming into the household, but we can't consider it when we calculate the debt to income ratio. So sometimes it's an inflated high number, but it's not, doesn't truly represent what their household actually is working with.
Right. And what's really important is, while you're qualifying for your home loan, don't go buy a boat. Probably is not a good idea.
Definitely
or
don't want to buy a boat. Don't buy a car.
Or furniture or any big ticket item during this process. Right. So you want to hold off on those things.
For sure.
And we've had that happen. It doesn't happen a lot, but it happens, a number of times a year where you're under contract and everything's going along beautifully, and then you pull a credit report, I guess, early on that buyer, and then most lenders pull a secondary credit report like before settlement.
Right.
And lo and behold, there's the furniture on there, there's the sailboat or whatever it is, and they don't qualify anymore. They're out of that debt to income ratio parameter. Right. And then the deal's done, over.
So, interesting enough, one of the positives of FHA versus conventional is that you mentioned about secondary income or secondary credit report. So it's not exactly an actual secondary credit report. It's what we call a refresh. It's kind of an update on the first credit report. But we update all the trade lines to see if they took any new loans out or if they increased any of their credit lines. And we recalculate the debt to income ratio. So that a situation like that would hurt somebody on a conventional loan. We actually aren't required to do that on an FHA loan. There is no refresh.
Okay.
So that first credit report that we run on FHA is the one we live by.
You know, I never equated that, why we're having this huge problem all of a sudden right before settlement, right? It's always before settlement. Everybody's freaking out. And we're going to switch it from conventional to FHA. That's why you do it.
I mean, that among other reasons. Yeah.
That's okay.
Yeah. And going back to
Wow.
that example where somebody would qualify for both loan programs, but FHA is cheaper, that sometimes would be a reason why we would switch it. So we made a conventional offer. They qualify for a conventional offer, but we get into it and we realize that FHA is going to be better for them.
Right.
And then we flip it. At the end of the day, the loan's approved, sellers get their money, buyers get their house. You know, no one really cares too much about the financing of it. I think as long as, if for some reason FHA came back and called for repairs or something happened, knowing that we could always fall back on that conventional loan program,
Right.
I think that's what makes people feel comfortable with it. But there would be times where it would switch last minute because of affordability issues.
Right.
Or they go out and buy a car and didn't tell anybody, and now we got to go back to FHA
Right.
because we don't require the credit refresh.
So it's an interesting, it's an option that I was, tacitly aware of. Now I am, full frontal lobe aware of. So that's really good information for everybody. So thank you for that.
Yeah, no problem.
Before we wrap up, I'm just going to do have a little bit of fun with this 1 or 2 word rapid fire answer.
Okay.
I mean, you can go longer than 2 words if you want. This is America. We have freedom of speech. But favorite movie?
Goodfellas.
Love Goodfellas.
Yeah,
Ray Liotta.
it was the best.
Your last meal on earth would be what?
Tacos.
Your favorite guilty pleasure?
Ice cream.
You work out a lot, right?
I try to.
What's your favorite workout?
I still like to run. I mean, I've been trying to do a little bit more weight training, but I do enjoy running.
How what's do you do it for speed or distance or both?
I'm at the point now where it's more distance than speed.
How far are you going?
I just finished. I just ran in the Broad Street run, so that was 10 miles.
Nice.
I don't work out at 10 miles every week, but I just did 10 not too long ago.
Wow. What kind of sneakers you're wearing?
Right now, I have a pair of Nikes.
Oh yeah.
Yeah, and
Nice.
they're good. I've done the whole gamut. The real expensive ones, the real cheap ones. But the ones I have now I like.
What's the longest race you've run?
I did 1 half marathon,
So that is
13.1.
Nice.
Yeah.
Nice.
Yeah, and I've done broad 5 times.
And then you get into the weight room too once in a while.
I do. Yeah,
How often do you weight train?
2 or 3 times a week.
Nice.
Yeah, I got a personal trainer now, so I'm twice a week with him, and then I usually add on at least 1 by myself.
And you're watching your macros, your nutrition.
I could be doing a little bit better with that kind of stuff, but we're gonna get back into it soon because now that summer's here, I have to.
That's awesome. I've been on the shelf a little bit. I've stopped playing basketball temporarily since December, but I'm almost back.
Okay.
Rehab. I had a little foot problem, so we'll have to talk about that
Yeah,
after
yeah.
the program, or we'll bring you back for a health segment.
Okay.
All right? What's your favorite book?
Great Gatsby.
Favorite sports team?
The Eagles.
How about baseball?
Phillies.
Okay, so you're a homer, right?
I'm a homer.
Yeah, me too. Me
Yeah.
too. Your favorite musician?
Tom Petty.
Really?
Yeah, I was always a big fan. I was very upset when he passed away.
Yeah, great artist.
Yeah.
Yeah.
It was. It's funny when the day he died, my phone was blowing up. You would have thought one of my family members had passed away. People were calling me to say sorry. I was like, well, I didn't know him personally, guys, but that's how big of a fan I am of his.
Yeah, he was very good. Excellent artist. So this has been a lot of fun.
Yeah,
right?
thanks so much for having me.
Right. So where can people find you?
Well, I am on Facebook. I have a website. My if you Google Dom Lombardo mortgage, I'll come up.
And that's under the Allied site, more than likely?
Yes. Yeah.
Okay.
On the Allied site, I'm on Facebook. I'm on Instagram. I'm on TikTok. I don't do a lot on Instagram, but I'm on LinkedIn.
Well, you'll have plenty of clips now from this,
Yeah.
to post. So
Yeah.
we'll get those to you, by the way. So that'll be good.
If I can figure out how to post them.
My editor will help you.
Okay.
Yes. So I saw on Allied you had a lot of reviews. Did I see a couple hundred? Is that like hundreds and hundreds of reviews? Is that what I saw on there?
Yes, you would have seen hundreds and hundreds. Yep.
Wow.
So every year they have they give out awards for who has the highest survey results, and I'm top 3 almost every year on that.
Wow.
So and I'm not trying to boast about it, but that to me is really important because it just shows. It's nice to hear that my clients appreciate me and that my hard work for them kind of pays off. Receiving the production awards is nice, but that's based off of how many loans you do, which is important. But to hear clients say, Dom was so friendly, Dom was so helpful, Dom made a stressful process easy and seamless, that is what makes me feel good about what I do. So those awards are important to me, and what my clients say about me, makes me feel good inside.
Yeah, that's the relationship and being a servant to the public and making the unseen seen and being able to articulate it in a way that is understandable. You're really good at that.
I appreciate it. Thank you.
Yeah. So, and your customers, love you.
It makes me feel good.
Yeah,
it really does.
And if you need any backing on it, just go to Allied website and it's all there under Dominick Lombardo. As well, you've been in the business for 19 years, you said?
Yep.
So when your career's over, right? Is that probably somewhere in the distant future, I'm imagining?
It's hard to say. Not anytime too soon.
In your 19 years of doing all of these transactions, thousands of transactions, right? Hundreds and hundreds and hundreds of clients, what would your words of wisdom be to that first-time home buyer just buying their first house right now, just like entering the market right now? What would you tell them?
Well, I would probably advise them to do everything they can to live beneath their means. I think that was something that you brought up earlier. I think that's so important. Sometimes I pre-qualify or pre-approve people for, I pre-approve people based off of affordability and to help them check the boxes. Like, we want this kind of house in this market or in this neighborhood. So, okay, you need to be qualified up to this amount. And then they'll ask me, well, what's my max? So, all right, well, your max is, $200,000 more. If you can accomplish your goals without going to your max, then I think you're in a really good position. Just because you can qualify for a $800,000 house doesn't mean you have to qualify for $800,000 house. I think that's important to live moderately.
So it's nice to know the Joneses, but you don't have to keep up with them, right?
Right.
And there's so much of that goes on in society, and a lot of it's always been, but now it's supercharged with social media and who's got the car and who's got the dress, the bag, all that. So if you live below your means, then you'll be able to get all that stuff. You just need to delay the gratification by maybe 5 years, 10 years, right?
Yeah.
So that I agree wholeheartedly with that. Yeah.
Because also too, I think when we max ourselves out, any little shift in our lives could affect our ability to keep maintaining, right? So if I max out and God forbid I lose my job or my spouse loses her job, and then we have to find another job that doesn't pay quite as well. Well, we were already maxed out at our higher income, and now we can't afford it because our incomes have changed, or God forbid there's an illness, or there's a lot of different things. Life happens, and I think it's good to have that like wiggle room.
So, Dominick, thank you for taking the time out of your very, very busy schedule. Dominick Lombardo is with Allied Mortgage. They're mortgage bankers, which probably is a better choice than the alternative, which would be a mortgage broker. Dom's been in the business for 19 years. He's my go-to lender when we have buyers that don't have a pre-approval letter. And we also suggest, even when they do bring us one from another lender or from a national company, we ask them to have Dom run their credit, and Dom could sometimes, or many, many times, beat the offer that the national companies are putting forth. And I've gotten to know Dom over the years. Dom is a good friend of mine, and he services our agents, and he services many, many other agents from other companies. And he's a class act, and you could be certain that your information is secure with Dominick. He's going to give you the best possible information, and he'll get you the best possible rate, whatever the prevailing rates are based on your credit criteria. He's going to come through for you. So, Dom, thank you for joining us, and we'll do it again.
Sure.
Very good.
Fun.
It was a lot of fun. Thank you so much.
Appreciate it.